All right, let's see what we got. We got check-in from Memphis, check-in from Dallas. All right. Okay, cool. Let's get it. And I see a few other people coming in. Memphis. Okay. Okay. Memphis representing. Oh, hold on. We got two more. All right. Welcome, y'all. Welcome. All right, I'm just go ahead and get started. All right, so here's what we're discussing today. I mean, my head is always in the way. All right, so agenda, we're going to start with traditional mortgages, right? We're talking about manual underwriting, renovation loans, get into some self-employed options, talk about some options for high net worth individuals, investors, non-US citizens, and then builders. All right. This is interactive. So if y'all have any questions, just put them in the chat, or you can also unmute too. If you want to show us your face, you can show the face, but you don't have to. But yeah, so if y'all have any questions, feel free to unmute or just put it in the chat. Let's get it. All right. So traditional mortgages, as you all know, FHA, VA, USDA, right? These look at for the credit. FHA and VA can go down to 500. Really, VA, it doesn't have a minimum credit score. Conventionals, they'll start at 620, and then USDA will start at about 500, right? For income, we're looking at 2-year work history, just the standard traditional loans, a 2-year work history. The time in school can be counted towards this requirement. So if they're a recent college graduate, they can use that time to count towards the 2-year. Down payment, FHA will start at 3.5, conventional 3%, and then VA USDA 0. Here's a chart, just kind of it shows it. The only thing wrong, there is an error here. This can be 3%. So the home ready, home possible can be 3%. But just a quick overview. Hey, conventional, you're looking at 3 to 5% down, right? If you put 20% down, you don't have any private mortgage insurance. For VA, if you have less than a 580 score, you have to put 10% down. And then VA, USDA, it's 0 and there's no minimum FICO. So those are your standard, the traditional cookie cutter loans, right? So let's talk a little bit about FHA, VA, the manual underwrite loans, right? So what happens is we use an automated underwriting system. It's called AUS, Automated Underwriting System, AUS, right? So we run the loans through there. If we don't get an approved eligible, then we have to try manual. So for manual, this is going to be like 500 to 579, so a low credit score, or if they have no credit. So if someone doesn't have credit, they can't actually get a home. What we do here, I don't think I'm talking about this, but it works like this. We manually pull some things, so it can be their car insurance, their housing utility bills, and then like rent, and we manually add that. So if someone does not have a credit score, they can still get a home. Financing is still available. They can just do an FHA manual underwrite. This means the mortgage can be no more than 31% of their income. The mortgage plus all other debts, 43%. And so on down here. If the credit score is 580 plus, again, 40, this will mean the mortgage can be no more than 40% of their income. And then their mortgage plus all other debts can be 50 if they have 2 of the compensating factors. I'll go over those a little bit more on the next slide. So this is all FHA manual underwriting, right? So another thing to note, if we're looking at manual underwriting, again, so manual is just we throw it through AUS, automated underwriting. We don't get that approved eligible, then we try manual. So for manual, housing and installment, you can't have any 30-day lates in the past 12 months. Also, too, for down here for revolving, right, we can have no more than 260 days, no 90 days. And also, too, for housing and installments in the past 24 months, no more than 2 30-day lates, right? So these are the guidelines for the manual. So for my agents on here, if y'all are sending your clients the new builds, new construction, you're usually going with their lender, right, for the incentives. If something happens and they can't pass FHA, the air conventional, You can look at sending them to me, right? And we can look at a manual underwrite if they meet these qualifications and the guidelines. So again, this is FHA, this VA manual underwriting. So the compensating factors, and we usually want two or more. Low payment shock. So low payment shock is what are they currently paying for rent and what is that new mortgage payment, right? A large down payment, that's a compensating factor. 3 months reserve. So if they have some money saved, manual underwriting does require 1 month. If they have part-time or other documented income that we're not using, that works. Large residual income. So residual income is money left over after everything, right? So you have the income, take out taxes, take out the mortgage, take out the other bills. That's residual. Residual is how much is left after. So if they have large residual, that's a compensating factor, right? If they have a co-borrower as well, job longevity. Job longevity is 2 years, same job. So you need 2 years, same line of work, right? 2 year work history, but 2 years, same job. That's job longevity. And then history of getting like promotions or pay raises. I think I got a question. Does large residual equate to low DTI? Yes, yes, it does. So, yeah, because if you have a large residual income, that means you have enough income to where your bills are paid and you still got some money left over. So, yes, that's a good question. Also, too, I see in the chat, we got a Memphis check-in and then a Austin, Texas check-in. All right. Good question. Good question, though. Okay, so renovation loans. So renovation, you got your FHA, 203K, you got your VA rehab, and then you have your home style as well, right? So renovation loans are simply purchase price plus rehab costs needs to be less than or equal to the after repair value. So this is perfect if you're working with someone and the house is off market, right? Where it may not pass an appraisal, but you have a first time home buyer that wants it instead of an investor. So what they can do is they can do a renovation loan. And it's not that tricky, it's not that complicated. The extra piece is you have a general contractor, they're going to walk the property, complete a scope of work. They're going to say, "Hey, I'll fix X, Y, and Z for 30,000, 20,000." So now their purchase price plus that contractor's bid needs to be less than the after repair value, right? So I'm going to show you on the next slide. I got like two of these where it kind of breaks it down. So these are all the renovation loans. My head is blocking USDA, but it's fine. So you have the FHA 203K limited, standard, Fannie Mae, Freddie Mac home choice reno, VA rehab, and USDA reno, right? So these are just, this is an FHA loan. It's the same typical FHA loan. The only thing added is there's going to be a piece where we're having a general contractor come and complete some work. So again, if you have a property that needs work, maybe you can get a buyer, first time home buyer even, to purchase the property using a FHA 203K, right? So it'll tell you here, so like the difference between limited and standard is mainly going to be the rehab, right? No minimum, max at 35, right? For standard, it's going to be 5, but they don't have a maximum, right? And then you'll see here, you can do 5% down, 3% if it's home ready, home possible. Still 3.5% down, still 3.5% down if they're purchasing. You can do this for purchase or refi. So if you have a client, maybe money is tight, they don't have 30 or 50,000 to fix everything, they can look at a refinance where, again, if the current loan plus the rehab is lower than the after repair value and they credit qualify, we can look at a refinance FHA 203K. Think we got a question. Can you select your own contractor? Yes, yes, you can select your own contractor. That is part of it. Hold on, we got two people waiting in the waiting room. But yes, yes, you can select your own contractor. They need to be licensed and insured, so they have to have like a license number. And let me show y'all the next page. Again, this is just more information on the renovation loans, right? So they can do this for 2 to 4 units, single family, townhouse, condo, right? All across the board, right? So seller concessions is going to be the same based off of that loan type. So it'll be FHA, the standard 6%. And then if they're putting down 10%, it'd be 6%. If not for conventional, then it's going to be 3%. Right. And then you guys are signed up. So everyone that's signed up, I'll actually email you this. So you'll be able to kind of look at the chart and kind of see. But this is the renovation home loan. So you have the FHA 203K limited, standard, Freddie Mac, Fannie Mae, Home Choice, Home Style, and then you have the VA and USDA rehab and rental loans. All right, so let me pause here. So we went over briefly the traditional loans, right? And then we talked about manual underwriting, and then we talked about renovation loans. Does anyone have any questions on either traditional loans, FHA manual underwriting, or renovation loans? What we just covered. No. All right. So let's talk more about the self-employed or loans for self-employed and for business owners. All right, so self-employed, FHA or conventional, any individual who has 25% ownership or greater is considered self-employed. Somebody in the chat, tell me what is a minimum percentage needed to be considered self-employed? What percentage ownership in the chat? What percentage ownership, the minimum percentage ownership that is needed to be considered self-employed? Somebody put in the chat. 25. All right. Yep. 25. So typically, right, we're going to need 2 years of tax returns to use self-employed income. But if they've been in the same line of work, right, and now they're self-employed, if we have 1 full year of tax returns, we can use and we can go off of that income for self-employed. Also, too, right, typically we need 2 years. So if they've been in business for 5 years or more, and they've had consecutive ownership of 25% or more, we can just go off of 1 year tax returns. So let me break that down. Let me tell y'all why that's huge. So a lot of times business owners, they don't show enough money, right? They don't show enough motion. So if they're taking a loss, like right now, check this out. If you have clients that are self-employed and they've been in business for 5 years, 6 years, and they plan on buying next year, you can tell them, show as much money as you can on your taxes this year. Why? Because that's going to put us in position to purchase next year. And they don't have to do it for 2 years, so they don't have to have Uncle Sam in their pockets for 2 years. So again, 25% or more, you're considered self-employed. We're going to need your business and personal tax returns, right? Typically, it's going to be 2 years. But if you've been in that same line of work and you're just self-employed now, we can use just 1 year if it's a full 12 months, right? And if you have ownership interests for the past, hold on, I got a question. They had to file taxes, business for 5 years, right? Yes, they do have to file taxes, just like a traditional like W-2 employee, and especially if they're self-employed, right? Because what happens is sometimes that is tracked and traced. So yeah, they do have to file taxes. Correct. Correct. All right. We will go on. All right, so calculating Schedule C income. So if they're self-employed, here's what the tax returns look like, right? So what we start at line 31, right down there. We add line 12, line 13. We're going to subtract 24B. Let me actually move my head for this. 1 second. Right? And then that's going to be the qualifying income. So again, we start down here, and this is nothing y'all have to really know. This is more like us as the loan officer, the lender, right? But sometimes just knowing this information helps you and gives you a little bit more confidence. Because sometimes what it is they're going to write everything off, right? And the qualifying income is too low to qualify. So, but don't worry, we'll talk about that in later slides, how we can get them qualified. But that's Schedule C income. So if they're a business owner, right, and we have the 1120s, here's what this looks like. So again, it's the same principle. We're going to take the taxable income, we're going to add and we're going to subtract the different line items, And then that's going to give us the qualifying income. Now, since they're a business owner, we do multiply by the percentage they own, right? So if they own 50%, the business made, $100,000, 50%, we only use 50,000 because they own half of it, right? So that's how we look at taxes. So again, and it comes to what are they showing on taxes if we want to go full doc or if we want to go FHA, VA, or conventional. So we talked about the traditional mortgages, right? We talked about renovation loans, we talked about self-employed. Now we're going to get into these other options if they're not showing enough taxable income. So I just showed you all the taxes, right? So if we're looking at taxes, I'm like, you're not showing me anything. You're not showing me anything. I'm going to show you the other options. So the first is going to be 1099 only. So this is if they are self-employed. Oh, hold on. All right. So this is if they are self-employed, right? So they're independent contractor, they receive 1099s. So we can use the 1099s, must be in business for 2 years again. Again, no W-2s, no pay stubs, no tax returns, just a 10% down, credit score starting at about 660. So you got like your photographers and wedding photographers, they can make some bank. You got like your truck drivers, things like that. But there's a ton of different 1099 employees out there. Or not employees, but rather people. So this is what an actual 1099 looks like when we get it. So you just look right here, right? Non-employee compensation, because they're not an employee, they're a private contractor. We're just going to take this number. That's what we go off of. It's very simple, very easy. So you'll see like right here, it'll say 1099, right? And we find line 7, and that's the amount we use. So 2 years of 1099 income, we will use that. It's pretty like simple, basic, right? So bank statement, this is a big one. So a lot of business owners and self-employed individuals, they go this route. So what a bank statement loan is, again, no W-2s, no pay stubs, no tax returns. They do not have to have their tax returns complete, right? Is we go off of 12 or 24 months of their bank statements. So like here's a description, or here's a bank statement, right? What we do, we get 12 months and we're just looking at the pay in, right? And we're going to see what are the deposits. And then we just make sure the deposit lines up with their business, right? Later, I'm going to show you guys a business questionnaire that they fill out with it, but we just make sure the deposits match for the business and we can use it. Because some deposits, they don't work, but we just make sure that they go with what the business or the business narrative is. 2 year work history. Again, if we're going bank statements, no W-2s, no pay stubs, no tax returns. It is simply 12 months of bank statements. Show us how much money is coming in. Now we do a expense
Can I
factor.
ask a question?
Yeah, go ahead. Go ahead.
Okay, so for the bank statement loan, let's just say, for example, you have someone that does hair, a young lady that does hair or does nails.
Mhm.
So what would that line item look like on the bank statement that would mean, hey, this is, let's just say, I mean, if they're paid cash from their clients and customers, what exactly are you looking for as a description for that deposit to prove that it's from the business?
So we would want it to show something that it looks like it's from the business, right? So again, usually this will be like a Venmo, like for hair, for braids, for cornrows, something where it says that or
Gotcha.
it has that, right? Because if not, we can't use it. But effectively, what I can do, right, is I look at the bank statements and I calculate the income, but I can also submit them into underwriting. So I can submit the bank statements into underwriting, have the underwriter look at it so we don't get under contract and it's like, I thought we could use that and we can't. So if it's something where it's unclear, I get the bank statements and just submit it to underwriting and I wait for them to do a bank statement analysis, which is usually like 24 hours. If it's not clear to me, I'll submit it to underwriting. Good.
Gotcha. So as a real estate agent, it's probably wise for us if we know someone that's wanting to purchase and they've got time to kind of prepare for that, they can begin to include those line item descriptions so that it's not an issue by the time they get ready to purchase.
Correct, 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 correct. Hmm. Great question, great question. And yeah, if you guys want to stop me and interrupt me, that's what this is for, because I want to break this down and help you. So another option, right? Let's say if the bank statements don't work, right, or the income isn't there, we can go a profit and loss. So a profit and loss statement, they can look all type of ways, right? Here's one, but a profit and loss statement has two or three sections. So the first section is going to be the cost of goods, right? The second is going to be income, and then third is expenses. So let's say if you're reselling a product, like if you're at a restaurant, you have to put egg, sausage, bacon, milk, tortillas, flour, right? That's the cost of the goods. If you're reselling, like, I don't know, skateboards or cars, you got to pay for it, and then you're fixing it up, and then you're selling it. So cost of goods would be the first section if you're reselling a product, right? If not, then the profit and loss will look like this, just two sections. Income, how much you made, and then expenses, what are your expenses? Right? And then we go off of this. So a profit and loss is an alternative if a bank statement does not work. So let's say again, the line items aren't clear, we can't use it, the underwriter's confused, then we may want to opt for a profit and loss statement. So credit score 660, we're looking at 15, 20% down. They want to see that you've been in business for 2 years. And then we can go an unaudited P&L. So an audited P&L is where you have to submit receipts and everything has to be extremely verified. It doesn't have to be like that close knit. You have an enrolled agent, tax preparer, CPA. They can just create an unaudited P&L for you that looks like this, right? And we will go off of that. Typically, some lenders want to see 2 or 3 months bank statements that back the P&L, so there's not that much of variation or fluctuation. So they do want to see like the bank statements kind of showing or agreeing with the profit and loss statement. So any questions about profit and loss? Or actually, let me go to the next slide. So if you have a bank statement or a profit and loss, usually you're going to complete a questionnaire because if you work at a company, we know what that company is. But if it's your company, we have no clue. So the questionnaire helps gives us a feel for what your company is. So how long have you been in business? What's the industry type, right? How much do you own? What's the description of your business? Big one is what's the website? What's the expenses? Is it a product or service base? And then also too, as we mentioned earlier, right? Can you tell us anything when we're reviewing the bank statements, including the source, deposits, wires, withdrawals? So they have an understanding of the business and they're not just looking at bank statements, right? So that's all these questions. The questionnaire is going to help the underwriter know what the business is, how the money comes in and out, and help your client get qualified. So any questions on bank statements, profit and loss, 1099, because all of these are pretty much together. So you got your 1099s, right? You got your bank statements. We're looking at how much money is coming in. And then you have the profit and loss, which is 2 or 3 sections. And we're looking at that bottom, the profit and loss number. Questions. Then you have the questionnaire. All right. So we went over traditional loans. We went over self-employed options. So we went through manual underwriting. We talked about renovation loans. We talked about 1099 bank statement profit and loss. Now we're going to look at some options for some high net worth individuals. If y'all feeling this, put a fire emoji in the chat. Put a fire emoji. If this is good, put a fire emoji in the chat. Let me see a fire emoji. Holla at me. Give me some feedback. Let me know. Put a fire emoji. All right, all right. All right, let's get it. Okay, so no ratio. So no ratio, this is a unique program. I know traditionally, right? FHA, VA conventional, you need 3 things: credit, income, and assets. You don't for a no ratio. This is your primary residence. You only need cash and credit. So in the chat, somebody tell me what are the two things you need for a no ratio loan? You need cash and you need credit. So in the chat, tell me the two things you need for a no ratio loan. Cash and credit. That is it. No employment is looked at, no income, no work history, no job requirements. You just need cash and credit. That's it. Cash and credit. So it works like this: 720 credit score, 20% down, 12 months reserves. Reserves means whatever the mortgage payment is, you need 12 months of that saved. Or 680 credit score, 25% down, 9 months reserves. Reserves is whatever the mortgage payment is, right? Or 660 credit score, 35% down. Somebody have a question? 9 months reserves. So that's pretty much it. No ratio, cash and credit. Your work history does not matter. None of that matters. You just need cash and credit, and you can use this for your primary purchase, not investment, primary purchase, cash and credit. Let me see in the chat. Did we get a question? Cash and credit. Okay, perfect. Okay, so asset depletion, sometimes it's called asset utilization. Can reserves be less on 800 credit score? So question in chat is, can reserve for the no ratio? No, so unfortunately you have to meet those standards. So if you're, let's go back to it. If you're looking at a 720 or higher, it's 20% down and you have to have 12 months. You have to have the 12 months. All right. So asset depletion, asset utilization, they're one and the same pretty much. Credit score does have to be higher, 680, 10 to 20% down. We can use 100% of money in checking, saving, money market, 70% stocks, bonds, mutual funds, 60% of retirement assets. So you can use assets in a revocable trust too if the borrower is a trustee. So we take all the assets, we divide it by 84, and that number becomes your income. So we take all the assets, divided by 84, that numbers become your income. So again, asset depletion, much like no ratio, it is simply cash and credit. But with this, it may not necessarily be liquid, so we can use 100% of that liquid money. But if you have a nice retirement account, we can use that. The only thing with this one, guys, is 6 months seasoning of all assets. So we do need to see that the assets have been there for at least 6 months, right? So that's asset depletion. So we'll have no ratio, right? Where you just need that 720 score or the 660, putting 35% down. Or we can take all the monies you have, divide that by 84, and use that as your income. All right, so that's the loan options for the high net worth individual, right? So we have that no ratio, and then we have the asset utilization. We went through self-employed options, which is 1099 only, bank statement, profit and loss, and then we covered earlier the renovation and manuals. Is there a season and time for the no ratio as well? Yes, I believe it's 6 months. I should have put that in there. I will check, but I'll send that information to you as well, as long as you registered. But yeah, I believe that's about 6 months. That should have been on the slide. Sorry. I just thought about that. Like as I was saying, I was like, oh, I should have put that one there too. Yeah. Yeah, no worries, no worries. All right, let's talk about loans for your investors. It's going to be fix and flip and then DSCR. Oh, any questions? Any questions? I know I just answered that last one about the no ratio, but any questions about anything we covered so far? High net worth individuals, self-employed, or the traditional or manual renovation loan options? Any questions? Okay. Let me know because I'll be talking. So y'all gotta slow me down. Okay, so fix and flip. So these loans are for investors where, let's say, properties aren't necessarily up to code and they won't pass an appraisal. So, FHA, VA, conventional, even some other loans, the property has to pass an appraisal. So if it doesn't, we can look at a fix and flip option. Here's the main qualifications, what you need to know, pretty much one slide. Minimum as is door value 75K. Now, fix and flip is hard money. So if you have like, let's say a local private lender, they may be able to go down a little under the 75K range, right? But if you're coming to me like a broker, most of the wholesale lenders I'm going to use or the private equity lenders I'm going to use, about 75K is going to be the minimum as is door value. Loan, 100K to 125 is the minimum, up to about 3 million. And again, if you're in a market where properties are a little cheaper, if you have a local private lender, they may be able to go under these amounts because these aren't like actual guidelines. It's more, this is more private money, hard money. So it's kind of whatever the lender wants to lend, right? So you have the credit score minimum. That's going to be about 660. Some they do offer no score. So there's a few lenders in a few states where they're not even checking your credit. Um, yeah. And then loan to ARV, so that's how much you can borrow, how much you can borrow versus the after repair value. It's going to be about 65 to 75%, right? So you're realtor, so you can do a CMA, and you can say, hey, this home will be worth X. So you know the loan will be capped at about 65 to 75% of that. Down payment, this is just going to vary with experience. So if they're an experienced investor, they can get around like 10%. But if they're newer, they might be pushing 20, 25, maybe even 30%, right? So that's fix and flip. I think we got a question. Could you do a property bundle for 75K, or does it have to be one property purchase at 75K? So typically it's going to be one property. So the minimum like door value. So I think I put on there. So each door minimum needs to be 75K. But again, if you're getting into a position where they're lower than that, that's where you want to look at someone like a private local lender. They may be able to kind of squeeze you in. But the minimum door value, so that means if you're doing like a bundle, each property itself needs to be 75K. Each door needs to be 75K. All right. All right, so here's a quick kind of like synopsis of what it looks like. So for fix and flip, you just need to work backwards. That's it. So you first say, what is a house worth after it's fixed up? That's the after repair value. So for here, we got like 330. Boom, that's your first number. What is a house worth after it's fixed up, right? Then you're going to have a contractor walk it, right? The contractor is going to walk it and they're going to say, hey, all the renovations that need to be done, it'll probably be like 65, it'll be 25, it'll be 80K, right? So now you have your rehab number. And then you, again, working backwards, you say, hey, it's worth 330. My contractor said the rehab work will be about 65. How much do I want to purchase it at to make sure there's enough meat on the bones? That's it. So again, you just work it backwards. What is the property going to be worth based off of other properties in that area? What are they selling for? Boom, I have the ARV, I have the after repair value. Have my contractor walk it. How much is it going to cost? Contractor's going to give you a number. And then you'll say, hey, if it costs that much and it's going to take 2, 3 months, 6 months to complete, I am comfortable buying it at this purchase price. And then you just, you have your numbers. So for fix and flip, you just work backwards and that's how the numbers work. And then, of course, you want to make sure there's a large profit margin because rehab can be delayed, right? If they don't have certain things, it could take a little longer. You're renting money, right? So there's interest only payments, there's property taxes, homeowners insurance, there's holding costs. So you really want to make sure you have enough meat on the bones. I think we got a question. What is the average interest rate right now for fix and flip? So it's going to depend on their experience, right? But to answer your question, someone with good experience, you're looking at probably 10%. Someone with no experience or newer, maybe about 13%, and it's going to be interest only. So about 10 to 13% interest only. All right. So now we're going to talk about DSCRs. So DSCRs, debt service coverage ratio. DSCRs. Somebody in the chat put DSCR in the chat. In the chat, put DSCR. In the chat, put DSCR. Oops. All right. So DSCR in one slide. This is a loan for investment properties, right? It requires a minimum 20% down and the rents to cover the mortgage payment. No income, no tax returns. So DSCR is what you can do. There's two ways. You can do a fix and flip. So you get something super cheap, fix it up, put renters in. Or you can find something that's already turnkey and ready to go. So some people, they don't want to work with fix and flips because there's risk, right? So let me go back. So, right, the rehab. What if the rehab goes over? What if while they're rehabbing, they find something else, right? Because that can happen. You can lose money on the flip if the numbers don't work or if the rehab budget is crazy, right? So you can potentially lose money. So some people, they're like, I don't want to fix a house. I just want one that's ready. So DSCR is for those turnkey properties that will pass an appraisal. Again, just 20% down. You want good credit. So if your credit score is 600 low, you're probably going to be putting like 30. You really want the credit score up there 720 to get more competitive rates. But that's the DSCR. You can do near and no debt options or no service options. What that means, let's say the appraiser goes to the property and the appraiser says the home can rent for, well, the appraiser says it's worth X. That's the appraised value. The appraiser says what it's worth. They also say, and it can rent for Y. That's called market rents, right? So we go off of that number. Sometimes that number is lower, or sometimes your investor knows the market rents are 2,000, but I'm renting out the bedroom. So I know I'm going to get more. Or they say, hey, market rents are 2,000, but this is actually going to be a short-term rental. I'm going to be making 3, 4, 8 times the mortgage, right? So that can be considered if they're using it for short-term rental. Let me see, and I think we got a question. What's the average interest rate for this? So for the DSCRs, the average interest rate, let me see. I'm closing one this week is going to be about 8%. So it's you can get something in the high sevens. It just depends, right? Because just like your traditional mortgages, what's the credit score, what's the down payment, and a few other factors that will kind of change or vary the rate. But you can see it high sevens. So I want to say like high eights right now ballpark. All right, so we talked about traditional mortgages. We talked about options for self-employed, a 1099 bank statement profit and loss. We talked about options for the high net worth individuals, the no ratio asset utilization. And then we talked about fix and flip and DSCR. Now we're going to talk about options for non-US citizens. So which is I-10 and foreign national. Okay, so I-10 it stands for individual taxpayer identification number. What proof is needed to show how much rent would be, or does a lender determine that? So good question. So um it can go either or. So we can use market rents. So the appraiser goes, they do the appraisal, right? And then what happens is we also get the rents from the appraiser. Some lenders, it varies. So some lenders, if you have a leasing agreement, they can go off the leasing agreement. So if you have a leasing agreement in place, some they're just going to go off of market rent. So it varies lender to lender if they're going to use a leasing agreement or if they're going to go off of market rents. Because sometimes like you don't have a renter in there because you just bought the property, right? So let me see. Perfect. Thanks. All right. Yeah, you're welcome. All right, so individual taxpayer identification number, I-10. So this is for someone with no social. They live in the United States. So primary residence, you're looking at about 20% down. They need US credit. So that's 2 trade lines for 24 months or 3 for 12 months, right? Government issued ID, it must match the I-10 number. Simple. That's that's it. So an I-10, it's just going to be a lot more down, right? And you can use it for your primary residence. For national, you're looking at 20 to 25% down. So if they have US credit, we can use it. So two trade lines for 24 months is what we're looking for, or three trade lines for 12. If they do not have US credit, we can use an international credit report from their country or a letter like from their bank, just saying, hey, they're in good standing. They don't owe a lot of money, things like that. The assets must be in a US account seasoned for 60 days. So for national, the assets got to be in that account for 60 days, right? So that's I-10. That's for national. Any questions on the loans for non-US citizens? I-10 for national. I-10 for national. All right. So here's what we covered again. We talked about the manual underwriting, renovation loans, self-employed options, high net worth options, investor options, non-US citizens. Now we're going to go over to the builders. All right, so buying land, right? Buying land, you're looking at 15 to 35% down. I know there's a jump. I'll explain it. Credit score about 660. So land loans, if someone's just buying land, like land only, it's going to be 20-year fix. So loan minimums 100K. Expect it to take 45 to 60 days to close. It just takes a little longer for land. And you want to make sure you're checking zoning or make sure your client is, right? Because typically most people are buying land to build on it. So you want to make sure what you're trying to do it's zoned correctly. Is it zoned R1, right? Or is it zoned commercial? You want to make sure you're checking zoning and how to flip zoning or how to get it changed if need be, right? So local credit unions offer great terms. I want to say the best. So in the chat, if someone wants to buy land, where should they look? Where should they look? What lender should they look to shop to? In the chat, tell me. Local credit union. Yes. So the reason being, so let me go back up here. You see I said 15 and 35. So if they're looking, so if you have a client, they come to me, I can do it. The rate just ain't the best, and I'm not gonna like lie to you, right? So the local credit unions, they can usually go about 15% down, and then this loan minimum is actually lower too. They can do the 30,000, they can do the 40,000, and 60,000. So if someone has a low loan amount, right, and they're trying to just buy land, I would highly recommend you get connected with a loan officer like at a local credit union. They're probably going to give the best terms, meaning you're going to be leaning towards that 15% down range instead of coming to me and it's like 35% down, right? And then 100K loan minimum. All right, so construction loans. So this is either you bought the land and now you're ready to build, or you're trying to build. So you can, with the construction loan, you can include the cost of land in it, right? So if they want to do that, then you can holler at your boy. So credit score, you really want to see it about 680. Higher score going to get you more favorable terms. Assets, we want to see the down payment, closing costs, about 6 months of reserves, and then about 10% of the construction budget and reserves as well. So experience, if they've done a few flips or construction loans, it'll be more favorable for the underwriting because they're experienced, right? If not, there's still options. Down payment, expect about 20 to 35%, just depending on, their factors, right? This is interest only for 12 to 18 months. With this, we're not looking at tax returns because think about it like this. When someone's building something, they're going to build it and that's it, right? So they're only going to be in that loan for 6 months, 8 months, 12 months. So for construction loans, right, we're not looking at W-2s, pay stubs, and tax returns. They just want to know, can you close, right? And then do you have about 6 months reserves? Because they know in about 6 months, the home will be fully built. Does that make sense? So this is a construction loan, is a short-term loan just to get the home built. And then you're going to be looking at refinancing or sell. So that's a construction loan. It's a short interest only, 12 to 18 months. If you don't have it complete, then usually there's options for you to extend. But typically like building, may only take about 6 months or 8 months to actually build. Even if there's some delays, 8, 9, 10, we're still within that 12-month range. Let's see, I think I have a question. Uh, what does the interest rate typically look like for these loans? If you're referring to the construction loans, you're looking at like 10 to about 13% as well. So about 10 to 13% for a construction loan. Okay, and the one-time close. So this is going to be if you have a client coming to you and they want to buy land and build on it, right? So those other options. So check this out, guys. The land, right, where you're putting 15% down for land. Construction, right? You're putting 20% down for the construction. But an OTC is where they can buy the land and build on it. The reason it's called a one-time close is because if you go the other route, right, you're buying land, you have to close on it. There's closing costs. Then you do the construction loan, there's closing costs. Then you do the permanent loan, there's closing costs. The one-time closed construction loan stops you from doing one, two, three loans and you just do one. So it's all in one. So it's the land, it's the construction, and it's permanent financing. Because with these, right, this is interest only, so it's a short-term loan. This is going to be your 30-year fix, so they don't have to refinance. And hold on, I think there's a question in the chat. Hold on. So yeah, this loan does allow first-time home buyers. Is OTC the same as a bridge? No, no. So the OTC is not the same as a bridge. And so let me explain. Okay, so the land is going to be pretty much permanent finance because it's 20 years, right? Construction, this is a bridge. So a bridge, think of it, it starts you here and it gets you to another destination. OTC is not a bridge because these are 30-year fixed loans. So it's the same as like an FHA loan, a basic FHA or a conventional or VA loan. The only thing it's at 30 years, but it includes the construction as well. So the OTC are not bridge loans. A construction loan is a bridge loan. OTC is not. It's a 30-year fix. So this allows you, we're looking at W-2s, we're looking at pay stubs, we're looking at tax returns, right? Credit for conventional about 660. I believe there is a VA OTC option that's about 640. VA, they want you at about 580 minimum. So down payment, you're looking at 5% conventional and 0% down if you're VA. What's the interest rate like for the OTC? Do you run into budget issues with OTC loans? Okay, so what's the interest rate like? So these are just standard 30-year fix. So it's going to be whatever the market is, that's what the loan's going to be. Because again, right, you see how this is a conventional, it's like a 30-year conventional loan. So whatever the going rates for conventional are. It's a 30-year FHA. Whatever the going rates for FHA is, it's the same thing. It's just the loan includes the construction and the land acquisition. Let me go back and answer that other question. Do you run into budget issues with the OTC loan? So here's the thing, you can't, right? So the goal is that you've done everything correctly and you have that margin of error or that space, that cushion, but you can potentially run into it. You hope you don't, right? But you want to have a cushion in there, but you can potentially run into that. And let me see, does the lender have to qualify the builder? What about draws? Did the lender give the builders draws? Also, is there an FHA? Okay, so one, does the lender have to qualify the builder? Yes, yes. So what we're looking at, oh, and by the way, next week, my master class is how to buy land and build on it. So I'll actually go into this a lot more, but I'm not going to stall y'all out. I'll answer your questions. Okay, so yes, the lender has to qualify the builder because the lender is basically backing the property. They want to make sure the structural integrity is good and everything else. So the way it works is like this. The main thing they're looking at is the builder needs liquidity. So they're either going to be checking bank accounts, checking the credit, They want to make sure they're not going to go bankrupt mid build or mid construction. And then they want experience. So they usually want them to have like three like projects that they built in the last 3 years. So they're going to need some money, liquidity, and then they want experience. So they want you to have done like three. So most lenders, what will happen is they have lists of preferred builders. So when they're going to do a OTC loan, the client will find a builder and we'll see if they're either on that list or the builder will have to fill out the documentation so they can get approved. But yes, the builders will have to be approved before the lender will back the loan. What about the draws? Does the lender give the builder's draw? Also, okay, so what about the draws? So there are draws. It depends how you want to structure the OTC loan. So there are some OTC loans where there are no draws. There are some OTC loan where there are draws. So sorry if I'm confusing you. So it just depends what route we want to go. Is there an FHA option? Yes, there is. I just didn't include it in this PowerPoint, but there is an FHA option. 640 minimum credit score is needed for that, I believe. I'm trying to think off the top of my head. But yeah, there is an FHA option for the OTC. How can a builder get on that list? So if a builder wants to get on the list, it's a bunch of lenders. When we're in the process, the builder will complete the application. It's like the builder's application. They're going to put all their information on there, credits ran and things like that. Their experience is checked and verified, and they're usually checking with like three sources outside of the builder to make sure that they've completed their builds and things like that. So they'll just complete a builder packet. I will come to the next class and yeah, come to the next class. Go more in depth. I got y'all. All right, good questions, good questions, good questions. Keep them coming. I'm here. All right, so we talked about traditional loans, we talked about self-employed, we talked about high net worth individuals, we talked about investor options, we talked about non-US citizens, and then we talked about the builder options. Now I have another one. I just wanted to throw this in there. I didn't know where to fit it, so I just threw it in. All right, so doctor loan. So if you have anyone like a doctor, I do have a loan program for them. You are looking at 10% down, the debt to income 45, loans 100K to 2 million. Now, here's the thing. Student loan debt may be excluded from debt to income calculation with documentation evidencing the loan payments are in forbearance are deferred to after the note date. So usually a doctor, they have all this debt, right? So they may not qualify FHA or conventional. Well, if their student loans are in forbearance or they're deferred to after we close, now we're not even using their debts and we're using all of their income. So there is a doctor loan, and then here are the eligible professions, and there's no mortgage insurance as well for this product. So recap and recapitulation, you have your qualified mortgages, which are QM. They look at W-2s, pay stubs, tax returns, right? And they have certain guidelines that they follow. FHA, VA, USDA. You have your non-qualified mortgages, which are outside of that. And the main thing for non-qualified mortgages is we have either non-traditional borrowers, we have non-traditional income, or non-traditional real estate, like the real estate, like it's being built, or it won't pass an appraisal, right? Non-qualified mortgages, the main thing to know, guys, higher interest rate, higher down payment to offset the risk because it's a higher risk, right? It's not an FHA, it's not a conventional loan, so it's higher risk. So that's the main thing. It's going to be a higher interest rate and a higher down payment. That's it. So if y'all have any questions, let me know. If not, let me see. I think I got a question right now. Thank you for the information, Conrad. Great class. Thank you. Thank you. Yeah, I like to like get in and get out, not waste y'all time. But yeah, if y'all have any other questions, y'all have my contact, Conrad Van the Mortgage Man, Instagram, Facebook, YouTube, Twitter, whatever. So y'all can contact me. Next week class, if you want to come or if you want to invite some of your clients, it's going to be how to buy land and build on it. So I'm really going to kind of just talk about more about the construction loans, the process, builders and things like that for the construction loans and the OTC loans. Great class. Thank you, India. Thank you. All right.
Hey,
So
Conrad,
yeah, yeah, go ahead.
and
Go
I'm
ahead.
sorry. You,
Princess, I think you muted.
oh, sorry. Okay, can you hear me now?
Yeah, what's up?
Okay, you probably went over this. I don't know if I missed it, but I know you said like everything was higher for the non-qualified mortgage. But I wanted to go over that
Mhm.
the
Okay.
non-qualified, like,
Mhm.
yeah.
Okay,
What was?
so
Go ahead.
all right, so you have the your basic loans, right? Which is going to be right here. So your FHA, VA, and conventional, right? So these are going to be the qualified mortgages.
Mhm.
So whenever we're stepping outside of that, then it's going to be a higher interest rate and a higher down payment. And the terms are
Oh,
going to be
okay, got you.
yeah.
Okay,
So like,
okay. So it's not a specific loan. It's the other loans that you went over that are not these.
gotcha. Yeah, yep. So like, let me
Okay,
see.
okay.
So like 1099s, you're starting at 10% down, bank statement 10% down, profit loss 10% down. No ratio, you're starting at 20%, asset utilization about like 20, fix and flip
What's the
20.
I don't want to cut you off, but what's the credit score for the self-employed?
Self-employed, so it depends. With self-employed, we can still do FHA, VA, and conventional, right? So
Mhm.
do you mean like one of these options, or do you mean self-employed showing the income on taxes?
Like the bank statement loan. Like what would be
Okay.
the for the 10% down, what would your credit score need to be?
You really want so it's gonna vary by lender, but you really want it like 720, 740 to get that. And then usually like with pricing, it still usually makes sense to go 15, 20% down, but we can always like price them out. But you really want like 720, 740 for a 10% down bank statement.
Okay, okay, gotcha.
Got you. Any other questions? No?
Do
All
you have to
right.
have a do you have to have a certain credit score for the D what is it? The
DSER?
DSCR?
Yeah, so
Yeah.
usually the DSER, again, you really wanted about like seven, let me go to it. You really wanted about 700. You can get by with like a 600, but your down payment is probably gonna be like 30-ish percent, 25, 30%. So it's gonna, yeah, and then it's gonna depend on if the rent fully covers the mortgage. But you really want to be pushing like 700 for that 20% down. But there are
Okay.
some lenders that do like high fives, but you're looking at like 30, 35% down for like a 580 credit score option.
Okay.
Hmm. What else? What else? What's up? What's up? We here. What's up? All right. Hold on, let me check the chat. I think I got like two questions. Me and my client will be on. All right. Oh, you talking about next week? Yeah. We do a master class on DPA. Actually, I have it. Like, look, I got so many classes I'm trying to do. But yes, I can put it on the calendar. I'll let you know. I'll put it on the calendar. So master class for DPA and yes, please send me the link for next week's class as well. Yeah. All right. So I'm gonna hop off. If y'all have any other questions, just tap in, reach out. My contact is everywhere: Facebook, Instagram, YouTube. And next week's class is how to buy land and build on it. I'll try to post that tonight. But yeah, if y'all have any questions, just reach out to me. I'll be here. Happy to help you, any clients. And I think we got one more question. Thank you. Oh, you're welcome. You're welcome. All right. I hope y'all enjoyed the class and peace. Signing out.